Welcome. This is the Edge live demo and discussion, July 20th, 2023. Only two ground rules. Mute yourself while we're talking and ask lots of questions. I really, I enjoy these. I've learned a lot and it's a good interactive discussion. And, I enjoy the data and seeing all of you. So it's always fun for me. Okay, so speaking of the data, I thought it would be useful because whether you're a longtime user or a new user, it can be it can be helpful to review whether this platform works. And of course, hopefully you just see the results in your trading portfolio. It work. I'm just doing exactly what I tell you. And since I have limited my risk, the last big mistake, and I hope it is the last, it won't be, there'll be something, was Crocs. And if you're new, I thought, well, the supply demand balance looks great, and I didn't protect myself, and the stock dropped 20% with earnings. It's one of the risks of trading earnings. But I wanted to say, if we look back, has Edge been helpful in understanding the current trends? And Brian Wilson pointed this out uh, this morning to the team. He said, that we had this relentless low volatility abundance in the low volatility portfolio. And I kept saying in the market desk notes, as much as we've got momentum opportunities, by and large, it is a low volatility market. And how would we know? Well, there's a whole bunch of low volatility opportunities. And son of a gun, the Dow Jones Industrial Average has one of its best stretches, certainly back to 2021, but really one of the best 15 periods since 1987 for the Dow, where it has posted today, 9 straight days of gains, and it's been a very strong measure. And well, there's a perfect comportment with what the data indicated. And it goes up a little bit, just like taking 1%, 1%. It works pretty well. But that has stopped. So now we know, it's predictive. It should tell us what is going to happen, and it's not perfect. There's no perfect thing, and I'm not saying that it is, but that has been very effective. That's one thing that I think is useful, and I'm going to share my screen. Another thing is what broad sentiment has indicated. Brian, okay, thank you very much for doing that. I keep missing that person. Okay, what did I want to do? Go to the platform. That's what I want to do. I want to point out this other thing that I think is helpful to review. If you look at what broad sentiment is doing, has it been a good gauge for the market? You could say, well, don't you say that when it's over 6, then the probability of returns declines? It absolutely does if supply rises. And what we've had really since the beginning of June is a pretty steep decline. Really, you could go all the way back to when we came out of the banking crisis. There's been a downtrend in the supply side, and demand has been pretty strong, pretty level, and stronger since June, well above 5. Let me zoom that in a little bit. Here's what I'm, right dead between the green line and the red line. And if you're new, I'll show you one thing about the platform too. And here's a good opportunity. Sometimes I just cut right to things, expecting everybody to know, and apologies for that. So below 4 tends to be a market bottom, and stocks don't do well when they're below 5. 5 would be right between the red and green lines. And you say that's a pretty narrow band. Yeah, but it's 500 stocks. So green line bottom, we can come back in. Red line top, just be more careful. In your long-term portfolios, maybe it's a time for greater caution, particularly going down to the supply side. If the supply side is rising, clearly that's a bigger problem, and it's simply not been the case. I even said a couple of times in the last week or maybe a little more, if this rises, then the run will be over. Well, it hasn't happened. It's just, how would we know that a run might be over? Maybe we won't know at all. But generally, when demand weakens and supply rises, it will be the end short term of a run. And we've just had excellent conditions. There's no question, and the data have indicated it. There's a, and I'm neither bullish nor bearish. I just like the data. If the data give us opportunities to make money on volatility, we use them. And when they don't, we don't. And that's really the extent of my concern. I certainly use the data, to offer some input to the folks who manage accounts for us to say, well, I want more exposure to this or less exposure to that. But from a trading standpoint, and I'm going to come back to this at the end as we talk about what's ahead, I don't spend a whole lot of time, theorizing is, boy, are we off on a brand new bull market and all concern is gone. I don't think of the market that way. So the point is, I think Edge has done a very good job of indicating what's likely to occur, that it would be a very good market, that the value stocks would outperform. That's really been the case since June expirations. Look, tech's done fine too. There are lots of opportunity to trade tech stocks, but that's been true. Also, what has been true, and it's just beginning. We talked about this NASDAQ 100 rebalance, where the NASDAQ wants to shave off about 12% from what they, everybody's calling the Magnificent Seven now, whatever you want to call them, and sprinkling that down through the ranks of the other 93 to try to reduce the reliance on big tech. Well, look at big tech. I mean, look at the portfolio. So supply, while it's still very low proportionately, it's well below 50, it has exploded. You say, well, demand's pretty good too. Yes, because there are also value stocks in this. The big tech is also value. It can be value and growth. It's both. But look at the NASDAQ. It is not performing well. And my concern is that if you try to reweight the biggest stocks, it will hurt the entire index, because there isn't enough liquidity to absorb that 12%. So where might that 12% go? To low volatility. Isn't that what you would do? If you had exposure to very large liquid stocks and your opportunity for that was going to diminish, what would you do? Well, if it were me, I would switch to, large cap value. That's what I would do, because I would know I can get in and out of them and they're likely to have less volatility. Well, that has been true. There's more data I could show you. We track all kinds of data, patterns. The patterns have been just unbelievable, particularly from active money. And when I say active money, I mean one of these four big behaviors that you see in a portfolio. If I click through the momentum portfolio, zoom back out, and you see at the end over here, active, fast trading, risk management. Let's see, where's number 4? Passive. There's not a lot of passive in momentum. That's telling too. It's not where the quants are going. But what are those? Well, they're the 4 reasons people buy and sell stocks. Active investment is story. I did the CNBC clip Tuesday night, and Raven, I don't know, I didn't see you on here, but Raven, if you're on here, thank you for sharing the YouTube clip. I asked the producers, I haven't gotten it yet, but I talked about the fact that stocks are products, not stories. How do I know? Because BlackRock, Vanguard, and State Street alone own more than 25% of the typical stock in the S&P 500. More than 50% of all public shares are owned by passive investors, people following models. 70% of the assets at the top 7 largest asset managers, and they have close to 45 trillion of assets under management. They're following models. They're not doing what you see all day long on CNBC. Netflix. Well, great customer ads, but what about this thing? That's not what the money does. Netflix is getting hurt principally because it has run way up, and we're at this inflection point. Options expirations. Probably money reduces its exposure, particularly because it's exposed to the NASDAQ 100 risk. Even if it's supposed to get more, it is a risk that the whole index suffers. That's what money does. So story, characteristics. Is it a large cap, mid cap, small cap? Is it industrials? Is it communication services? Is it value or growth? Does it have quality? Does it have momentum characteristics? That's what money does. And far and away, the largest thing that motivates those models is market cap. It's the easiest. I need liquid size because I've got massive amounts of money that we've gone from 35 to 40% exposure to US equities. And so I need more of that. or we're de-weighting equities and we're shifting to fixed income or alternatives. That's what the money does. Fast trading is price. The machines chasing bids and offers. It's over 50% of market volume. And then derivatives, which are resetting right now during options expirations. There are people who bought volatility a month ago and who sold it and who lost. Well, probably the people who sold it. So they may have to buy stuff to cover the losses, which means next week they have to sell stuff. But that is what's going on. Oh, did I? Oh, here, let me. Hang on. I'm not muted that I can tell. Can you still hear me? You guys still hear me? Chris, thank you for the high sign. So I don't mean to go off on that. You can't hear? Martin, it might be you. Might be you. Let me see if I can reset you. There I go. Hang on. Let's see if we can fix Martin here. Sometimes this will do the trick. Oh, we just lost him. There's an issue. Mike must have gone down. Okay. Anyway, the point is that we saw a lot of active money surge into the market, and I think it went heavily into blue chips. I mean, it went into the S&P 500 too, but there are a lot of those sprinkled through the market. But if low volatility is predictive, we have come down dramatically in the number here. And you say, well, it looks like a lot of momentum. It's one day, and it's during options expirations. If this persists, then we can infer that we will have a period of momentum over a number of days. It gives us a period of time. If that doesn't hold, and I'm skeptical, then we'll see. But the data have done a very good job of telling us what to expect. And sometimes I think we're in the weeds and we don't appreciate that. Wow, it kind of told us all of this stuff. And we'll come at the end to what may happen next. Something really quickly, I want to review for anybody who's new. I pick up one little thing. There should be in the reminder that goes out to you now when you join a demo, a little video. It's not great. I shot it. It's not great, but it goes through some basics for you about using the platform. I just want to show you one quick thing here. If you are still, floundering around on the platform, here's quick search. I use this in the images in the market desk notes. Nearly all the time, I will use a 30-day view. If I say, here's an awesome supply-demand divergence, strong and rising demand and falling supply, particularly day over day, I like to use this 30-day view. So it's a 30 trading day view, June 6th through yesterday, July 19th. And you can also then go find Twilio in any portfolio. Where is it? It's in momentum, and it should be in at least one other. It may have to search around. Yeah, it's in tech. And that's how you can get to them. Then you can isolate. If you want to say, well, I just want to look at Twilio in the portfolio, choose this drop down over on the side over here. And then you can come over here and just type in Twilio, and then it will isolate that stock for you. And it's a great lesson on entries, which is the very next thing. Just to sum up here, though, going back to the predictive qualities of the data, it's not perfect, but it will tell us that there's good strength in the broad market and where we might find trading opportunities. Are they low volatility? Are they momentum? And you could trade them both at the same time. It's just that if there's a concentration in low volatility, we may have a little higher risk in those momentum choices, and vice versa. So now, this is a great lead into entries. I like to spend a lot of time talking about entries. Before I do that, let me pause briefly and are there questions, observations? Somebody wants to push back and say, Quast, I've not done well and I'm not happy. Go ahead, you can do that. I don't mind at all. I'm very confident that the data work, but it doesn't mean we use it right all the time. I don't periodically. I have tried now to make very few mistakes with the data. And if I don't, I'm almost always good. Martin, you're back. Good. Okay.
Okay. Hey, Tim, I got a question. So I've been using your trial for the demo for like a couple days now.
Yeah.
And I've seen you on the Benzinga show and pay attention. So it seems to work if you have the right amount of, risk management either direction. But well, just one technical thing. If you pay for it, does an error loading the dashboard occur often? Because periodically I'll go and refresh it and it just keeps showing me an error. I'm not sure if that's because it's a trial or not sure.
No, you should not be getting, and if that happens to you, let us know. I am aware of we haven't had system-wide issues for quite a long time.
You can see that, right?
Yeah.
Yeah. So I just go like this, refresh it, or go here, and it shows like this didn't look like yours did. And then if I type in TWLO,
you know what you may be encountering, Martin, which is why we use this technology called Azure Blazor. It's a Microsoft product, but if you look at my screen, I'll show you how you can do this, and it's a far more, how do I put it? It's a more adaptive technology. It is still technically browser based, but notice that this looks like an app. So in your case, you should be able to, if you're at, I'm going to go up here. So if you go up and let's say I'm going to open another, and you type app.marketstructureedge.com, it's going to take me straight to my dashboard because I've already used it. But then over here, you should see some instructions that would let you download that app. And it's super fast because it's not actually a mobile app. It is another step beyond mobile apps. Mobile apps you have to maintain separately from other apps, and it's kind of costly. And this approach, we were early adopters of this technology. Then it becomes an app. So I just have that app pinned to my taskbar, and I have it on my phone too. Just the app, I just use it on my phone like this. And that thing is wholly adaptive to any kind of browser. And we don't have those browser incompatibilities. Most of the time, the issues that you're encountering are going to be browser based. But if that happens, I'll make sure that I have our engineers look at that for you. We can generally figure out what's going on. Just let us know, and we can probably solve it for you.
So you're saying it needs to say app.marketstructureedge.com/dashboard, right?
Yes, that takes you straight to effectively the database. But Azure Blazor is like the opposite of going to a platform where you go log into a platform and you arrive at the Hive. Effectively, Blazor pushes the Hive to you, the pieces of it that you use. So it's a very, very efficient way to use data, keeps our broadband costs down, or our cloud costs down.
Right.
But yeah, that should work. So catch me, and we'll make sure we get that solved for you. Because no, you should not have errors. I almost never have an error. The only time we have an error is bad data, and it's happened a couple of times in the last month where there was a missing piece of data, and that causes an unhandled exception. Then we have to go look at the logs and go, oh, that it's associated with this ticker. But the app itself should not be giving you any errors. I mean, we want error-free 99.99% of the time, and it should be.
Okay. And then,
all right.
What about like parameters on stock selection? Like, can you go through that and define like,
yes,
what you set up to filter it through?
Yeah, absolutely. And look, I use all of these criteria, but I trade low volatility or momentum. I mean, I'm not out hunting for stuff. It's actually a point I wanted to make, and I'll show you. Yes, I will show you how to do this. But again, it's like the way I would describe this is I would say, look at momentum. Yesterday, I didn't get a single entry. Everything moved right off the bat, and I didn't have anything that was down half the day's volatility. A couple of things were close, and FTI was pretty close to down half its volatility, but it never got there. And so I didn't trade anything yesterday. And you say, well, Quast, you missed out. No, you didn't. There's no such thing as missing out. There is only buying something and selling it at a better price. That is all I'm interested in. What is occurring in the broad market has no bearing on whether I buy, pick a stock in here, Twilio, or today I bought TTD again. And I'll tell you why I bought those. So here's how you can find criteria. But again, why look further? That's the thing. You can do it. You can look for whatever you want to look for. The edge is trying to save you time and effort so that all you have to do is come in here and this is a set. It's like a herd. All these things have the same characteristics. They don't all move the same because money will be in and out of them at different times. They may have slightly different liquidity, but they're all going to be liquid stocks with similar volatility, similar supply demand characteristics. That's the idea. So that you don't have to root around. And you might say, well, if you can't buy down half the volatility, what if we bought at the open or we bought the midpoint price? Are there other ways we could go about it? Sure. And maybe there are incremental benefits to that. But ultimately, if there is a methodology that delivers extraordinarily reliable 80+% of the time, I make money on a trade, then why would I look for 82%? Right? I'm not saying I'm not going to do that. I've got Nate, the mathematician, young Nate, the mathematician, doing some additional math, looking for, well, what about this factor or that factor? What if it was 1.5% instead of 2? So we'll continue to look at those things, but you don't have to go do this if the platform does it for you. Now, having said that, here's how you do it. If you want to build a dynamic portfolio, and let's say you want to find all the stocks in the market that have spent at least 10 days at 10. So, because we want to find stocks that have momentum characteristics. How many days operator? Yep. Let's say greater or equal to 10. We're going to add that rule. And that is currently at 10 is equal to 10. So we're finding stocks that have spent in the last 30 days, 10 of those days, at least 10 of those days at 10 and are at 10 currently, and that they have a short volume trend that is equal to down, add that rule, and that the short volume level is less than 50%. Why? Because if more than 50% of the volume is borrowed, the bottom can drop out of it because any decrease in demand will lower the price. Look, there are many situations where stocks with 50% volume continue to rise if demand is very strong. But let's just say, so that's what you can do, right? So now we have a set of criteria that are going to look for, there's no liquidity characteristic in there, and we haven't put any market cap characteristic in there. So we could get some untradeable crap, but it's a good case in point. So then we filter that before we save it. And what does it give us? We'll just go to the bottom and find out how many. It gave us 71 stocks out of the 3,100 on the platform because we are after national market system stocks. There are only 3,500 of them in the national market system market. And 400 of those are micro caps that are not, they're rounding errors of market cap, and they're not worth trading. So now I could go, all right, I want to trade the largest stuff that I found, right? So the biggest stock that I found in this is Adobe, right? So Adobe's at 10, and the trend is up, which means it just got there. 43% supply. The supply trend, 30-day supply trend is down. Price is here. It moves 2.5%, 2.4% a day. Very liquid. Trades 3.4 million shares a day. So I would say, well, that's a pretty good stock, right? The reason it's not in the momentum portfolio is this. The supply has risen for 2 straight days. In the momentum portfolio, we only want supply that is falling in the last 5 days, particularly 1 day. Why? Because there's still a really stout supply-demand imbalance. This is already breaking down. So even though it has strong demand, could Adobe give us gains? Yes, but they become less reliable. To what degree? Well, enough a degree that I would take something in the portfolio that Edge is already doing for me without any thinking. But that's how you do it, Martin. Then if you're going to trade it, here's what you would do. You'd say, okay, and interrupt me at any time. You would go out here and say, okay, well, let's go look at Adobe. And we know it moves 2.4%. That's from high to low on any day. But what, I mean, all I'm looking for, is it down 2.4% or is it down some portion of that? ADBE stock, where are we here? Okay, so, it's down 2%. All right, well, what's the probability that I could make 8% on that by tomorrow? Mathematically, very high. Not quite as good as in the momentum portfolio, but very high. And you would say, why? How do I know that Adobe isn't just going to continue to fall? Well, we don't. But the reason that this works is twofold. Number one, there is a supply-demand imbalance. We know there is a bias to demand. We also know the price of that stock moves naturally 2.4%. It doesn't always. It could move, 30 basis, 4%. And that's how we get the average. But we know that's on our side. If you just tried to go trade volatility, it will be a mess. It'll be a coin flip because you don't know the supply demand imbalance. Machines do, so do we. We are measuring trade executions to see how are these behaviors affecting price? Well, there's a bias to the upside. So if it's down today and there's still a bias to the upside, what is the mathematical probability in the next day or two that it will be higher than $516.67? Well, pretty good. And I'd put a stop down 50 basis points maybe, because that's the full range of Adobe's intraday volatility. And I might get stopped out, but it's a risk I'm willing to take, right? Is it not going to take much risk? I bought TTD today and I'm risking about 30 basis points. I'm not even risking $200 on it. And I own $25,000 worth of it because I'm not going to take any more risk than that. And I don't know how it's doing at the moment. If I had my, let's see, I don't have it up right now. I don't even care. I don't worry about it, right? I'm down. I have high confidence that I'm likely to make 2%. And I've actually got my limit set at 1.3%. Why? Context. Options are expiring right now. It reduces my return probability and increases the risk. Why? Well, because options on it expire tomorrow. What happens if a bunch of options expire without being used? Well, it could give back 3%, just like that, because it's implied demand that goes away. It might renew on Monday. So all of these things are things that I think people should think about, not obsess over, but beware of. Because if you get 5 or 6 out right, you're going to be right. Okay, so it's a great illustration, and it kind of covers what I wanted to cover, Martin. Question?
Tim,
Yeah.
A couple of items in the chat room.
Okay. Where are we? And Martin, I want to make sure you got that, but the trade for us towards the end of our, do you mind describing that trade for us? Okay, let's see. I like to get your opinion on Twitter. Okay, I'll do that, Alex. Okay. Okay, from low volatility, you closed the trade with a 1.3% prop. Excellent. That's exactly right. And we're still, you could see with the Dow Jones, that while the low volatility portfolio has dropped from close to, what was it, 30? 30 down to 13 now. We know it's fading. Doesn't mean it's gone. So it's good to, now you start thinking about these low volatility trades may be harder to do. But that is what you did, Gary, is exactly what you want to do. And it's not sexy, but it's also very low risk and very high probability. And it's a really easy way to make money. I made, on a $30,000 trade, I made $700 on TTD, which was exactly 2%, while I was in meetings on Wednesday. It's very low risk. Alex, Twilio. Okay, well, why did I buy TTD versus instead of Twilio today? And let's look at Roblox and American Airlines and CrowdStrike. Okay, Twilio. So I'll just talk about Twilio really quickly. It's a great opportunity, and it's NYSE listed. It's not in the Nasdaq 100. Oh, Two Harbors. That's not the right stock. It's a good town in Minnesota on the North Shore. Two Harbors. Okay, finally, here we'll get there. So it's down 7% today, more than it's. And you look at this and say, what's the volatility in Twilio? Let's go back over here. I'm not going to save that, Martin. That was just an example. Okay, so Twilio 5.1%. So it's down more than its volatility. That, how, if there's going to be a higher risk of that occurring, it will occur during options expirations. Index options expirations today, VIX expirations yesterday, tomorrow, triple witching. I don't necessarily like the term, but it just means that stock and index options expire. Single stock futures don't. So there are basically three things instead of four. But that will increase the risk. There are things we can't see associated with the derivatives tied to Twilio, and it can cause that. And so one of the reasons I picked TTD, which was down very similarly, over Twilio today, is simply because I'm wary of tech here because of the NASDAQ 100 reweighting. And he said, well, you just said it's not in it. No, it's not. It's an NYSE listed company, but it's tech. And all of tech will be affected by the magnitude of this shift in some large elements of it. And so I thought, well, if I'm going to pick one, if they're both good choices, anything in here is a good choice, but I'm going to take the financials because the financial sector looks so good. So that's why I took TTD instead, or trade desk and communication services. Sorry, TTD in communication services instead. I mean, it's a smaller group of stocks, and I prefer the supply demand balance in that sector. Okay, AA. Let's look at that. Earnings are tough. I'm very wary of trading stocks. Was it not American Airlines? It's Alcoa. Is that right? AA. Okay, and my bad. So, I mean, that's good. It's right at 10, and day over day decline in supply. I would want to look to see what the liquidity is. I mean, it's a great stock. I don't know when it reports results. Maybe it already has. It tends to report pretty early. But from a supply demand equation, that's pretty good. Again, risk is higher during expirations and during earnings season. Let's see, CrowdStrike. It's a fabulous supply demand divergence. Very strong demand. It's not to 10 yet, but that should get, particularly if that's down today and it's not reporting results. Very high probability, and you're not looking for it today per se. Futu was a great example of that. It dropped most of its volatility and it didn't recover it, but the next day it was up 8%. And so what you're banking on isn't what the price does, but that the supply demand divergence is going to give you a gain. And it's not all of it. You just say, well, what is the probability that I can get some part of the 4 or 5% that it moves every day? That's what I'm after. I'm not trying to make 20%. I just want to take 2 or 3. And if you repeat that without losing money, you are way ahead, no matter what else is going on. I repeat that, I know. Yes, Martin. And Dan, I'll come to you.
So my question was, when does the software market structure edge recalculate those graphs? Is it done at the close, or is it done during, like if I'm trading right now, the market's still open. So
yeah,
if I refresh it, is it going to change?
Yeah. And realize it's predictive. So you don't have to know instantly. The whole point of market structure is that it's like, it's like an aircraft or like weather patterns. Turning an aircraft, you move the cyclic, and then sometime later the response to that, right? It's not, exactly. And the same with, you could see mare's tail clouds 2 days ago here in Steamboat, and I grew up on a cattle ranch. My dad was better at predicting the weather than the weather forecaster, and he goes, well, 2 days from now the weather will change. Well, it rained overnight. So it's kind of like that we don't need to know instantly. We want to know what the thing is today, because 2 or 3 days from now that will be the effect. That data updates, so it's dependent on exchange feeds. So trades get processed, and 99% of it gets settled, and they populate feeds that we subscribe to, and we get those roughly, I can't say exactly because it can vary depending on volumes, but roughly 8:30 p.m. Mountain Time. It's not at the close. It takes a while. Then we have algorithms that machinate all that data and populate the system. That takes us another 2 hours probably. So it's close to, we say it should be there 11 p.m. ish Mountain Time, which would be 1 a.m. Eastern Time. That's kind of what we're after. It's pretty consistently true.
Okay.
Yeah, it might speed up. It might speed up if we go to T+1 settlement, but that's where we are now.
So as far as a market rotation,
Mhm.
does it pretty accurately describe those? Because I'm thinking, yeah, like I was looking at it before I downloaded it on Monday, and I was thinking it looks like things are moving into energy and financials. And just from looking at the SPY and the other indexes and the other
Yeah.
ETF funds, and then I noticed I downloaded your software and I looked at it, and it was kind of showing the same thing. So I'm wondering, is there a special portfolio that you have that predicts market rotation? Because that would be very useful. I mean,
It
if you,
would. I agree. Yeah. And I said on Benzinga pre-market prep on Monday, I said it's going to energy and to some degree real estate too. And we could see that in the data way out that was occurring. It would be nice to have a better tool that does this. I'm looking for something here that I could show you. I have to think about where it is. I could search for it. Sector, is that sector trends? Am I right, Brian?
yeah,
This is it. Okay. Yeah, this is it. So here, we use this, and it's actually one of the edge users, John Cook, created this, and we mimicked him, as he said, "Hey, I've just been dumping the data," which you could do. You could dump data into Excel and track this. And if this is a good tool and we figure out how to do it, we'll just add it, so that you could look at this yourself. But if I want to look at what was happening, let's see here. Let's go to what happened yesterday, and refresh the data. I like to drop these two there. So this shows us how much is bottom. 17% of the total market is bottomed. 13% is down, 25% is topped, and 45% is up, which is really interesting. And then you go look for what is up. And when I backed up, see, it's already changing. On Monday, real estate and energy had were bottomed or up dominantly, and it's already changed. So right at the moment, financials has the most that are up. Tech has a pretty high number that is up too. 25% top, very few headed down, but that just means that could begin to deteriorate. So I would say, is this more predictive than broad sentiment? No, statistically, it is not more predictive, but it's informative. So you could look across it and say, well, is the market bottomed, topped, headed up, or headed down? And you'd look across this and say, well, it's more topped and up than it is bottomed or down. And so what does that mean? Well, it fits perfectly with what we see in broad sentiment. If we come over here and look at broad sentiment, what is it doing? Well, it's still rising. It never even dropped below 6, and it had this shallow decline, and then now it's still rising, and supply is trending down, though it ticked up one day over day. That's exactly what that data, it's telling us exactly the same thing. Now it could change pretty fast, but yeah, I agree. It is very predictive. Dan, hey, hold on, Martin. Let me get Dan in really quickly here, and I'll come back to you. Dan, please.
Okay. Entry. This morning, things looked really good. Lots of momentum stocks down half their volatility.
Yep.
So, for instance, CrowdStrike. So I went into it and got stopped out. It's still going down.
Yep.
I think you answered part of my question. Maybe rebalancing has got something to do with this. But now, as of now, CrowdStrike is down 6%. So, did you go back into it? How do you deal with that kind of situation?
Yes, I would. Right, that is exactly what I would do. but it really highlights the point that you have much greater risk if there's going to be a point where you think the stocks may behave differently than expected. I say this all the time. It is during earnings and options expirations. They may do things that are a little riskier. Right,
Yep.
right. And I'm a little concerned, particularly about those tech plays. Yeah.
Yeah.
But
Yeah, I would say based on my experience today, it might be a good time to sit out.
That's Karen was saying the same thing to me. She's like, well, you could just sit out. Why even bother? You know it's
Well,
going to be riskier.
if your wife did it, then I'm definitely going to do it.
Yeah.
Just a quick note.
Yes.
Earnings is critical. So you try and avoid within
Yes.
maybe 5 days, whatever earnings.
Yep.
For all the trade desk users, if you run your monitor and you list your stocks, there is a column with earnings. And so the first thing I do when I list a column is I sort it on earnings and I eliminate the nearest earnings before I go anywhere.
That is a great bit of advice. That is an excellent input. I should do that with IBKR because I'm sure that data is there. Yeah.
It's a little bit hard to find, but it is in one of the columns and it's called upcoming earnings.
Okay. Excellent. Okay. Martin, I know that I didn't ask, you had another question. And we've gone long, but if you'll bear with me, we'll be finished in 2 minutes.
Well, just to kind of circle back to what he was just talking about, CrowdStrike and 6%, wouldn't it be a good idea to wait until you see the close of the day for the system to recalculate everything to see where that's at before getting in?
Well, if you're going to capture the highest probability of an upside is buying all of the downside. So I'll go back to Futu again. The only way you could have made, and Brian Wilson bought call options too and made 285% on those. So, but you couldn't have done that without being in the position before. What you're trusting is that the data today has predictive qualities that will help you. To Dan Eisenberg's point, they diminish during options expirations. Why? Because derivatives are black holes. They bend. The only way you know they're there is they bend light. The only way you know they're there is they cause stocks to do things that they shouldn't do. CrowdStrike shouldn't go down 6%. The reason it is probably because the rights people have, the call options, and I'm oversimplifying, because there are exchange traded standard ones and non-standard ones, and hedge funds use a lot more non-standard ones. They don't want people to know they have big baskets, so they buy them through Goldman Sachs, and they're just a contract for difference. But if CrowdStrike is down and those options expire tomorrow, a bunch of them now are not worth as much. And so some of the implied demand for CrowdStrike goes away, and it can drag the price down that much more. There are some ways you can kind of get to that, but it's very, it's difficult. So that is a risk. But all other things being equal, you want to act on today's data because today's data tells you what tomorrow or the next day are likely to be, and so on. And just like the portfolios are telling us now, what are the portfolios telling us? That the Dow Jones Industrial Average's great run is about over. I don't know when it's going to end, but this has come down from 30 to 13. People are full up on low volatility. We're running out of that basket. And so people will stop buying it. And that's predictive. So then you can say, well, is this predictive? It's not as reliable during options expirations. It jumped from 7 to 14 to 22 in the last 3 days. But I think it's going to be very short term, and it might be distorted by options. But that's what matters more than having, I need the next set of data. No, the data are just fine. The data will tell us what's happening some days out. Let me finish with this, and I've taken it longer than 2 minutes, but I just want to finish with this. There's a lot of talk about, the market is, when the market performs this well, there are people who say 100% of the time the market is up 6 months later, 12 months later, 18 months later. When we post these kinds of breakouts from technical levels, almost always the market closes higher a year later. There are all kinds of those discussions occurring. And what I just want to mention is I I don't know, and nor do I particularly care about those things. I don't know if they will be correct. We have never done what we did the last 4 years, going through a pandemic, flooding the planet with money. I don't know if those things are going to be true, but those things need not worry you. If you're trading, um, the trading decisions will be the same. If you're metering Gary Morris, you're metering some risk using Edge and S&P 500. This will continue to do that for you. If this begins to deteriorate, if we revert to this and this very low supply period deteriorates and demand begins to decline, that is all that you need to know. And it doesn't matter what the prognosticators say. The kind of returns that we've been getting will end. If the conditions we have now persist, we'll continue to deliver gains on the broad measures. It's, to me, not more complicated than that. So with that, we went long, but that was a useful discussion. And I look forward to it each week. I'll catch you next week. We'll do it again.